Hello, ladies and gentlemen. This is your teacher Usman Ali, and we are here to discuss exercise 5.8 of the balance sheet chapter. Now, the exercise is related to development of current asset and the current liabilities and the long-term liability sections. Actually, we are not actually supposed to prepare the sections, but we are here just to see that if these transactions given to us, are they related to current liabilities or long-term liabilities, and how much amount it would have actually. Okay, so let's start with it. So our first transaction, okay, by the way, we have to prepare do the calculations for the Frederick Chopin Corporation, and the date is 31st December 2004. Okay, so the first event or transaction is on December 15, 2004. Information, actually, you can say, on December 15, 2004, which is like 15 days before the end of the year, the company declared a cash dividend of $2.50 per share. So they have just declared it. Okay, remember this thing, that declaring a dividend, announcing a dividend, does not make the company liable unless and until it is recorded. Okay, so 2.5 per share to the stockholder of record on 31st December. It means that on 15th December 2004, the company had declared that we will pay dividend of $2.50 on every share, and this dividend, which was announced on 15 December, will be recorded on 31st December. So 31st December is within the limits of 31st December 2004, the annual year end. Okay, so once you announce it, it doesn't make you liable, but when you record it, then you become liable actually. Okay, then you have to create a liability here. The dividend is payable on 15 January. So there are three dates here. One is the announcement date, then is the record date, and the fourth one is the payment date. So no matter if the payment date is in the next year as well, but if the record is created in this year, then obviously this is a current liability, and we had to record this current liability actually. Remember these 3 days. Okay, the dates are what? Announcement date, record date, and the payment date. Okay, so if the record date is the main point is the record date. If the record date is coming inside 2004, then it will be recorded in 2004. If the record date is coming in 2005, then it will be recorded in 2005. Okay, so let's solve the numerical. We are not supposed actually to prepare a proper current liability or long-term liability section, but it's just that we want to know that will it be a current liability or not. So as far as the transaction number 1 is concerned, it is indeed a current liability. Why? Because the announcement is made on 15th December and the payment will be made on 15th of January. So it will be just 15 days in the new year that the payment will be made. So it is less than 1 year. So it is no doubt a current liability, but how much it will be, let's calculate that amount actually. So we have that 2.5 per share. Normally, if I want to know how much dividend must be paid actually, so what I do is I will calculate my, like, how much would be my dividend payable, or the amount that I will pay to my shareholders. So dividend payable can easily be calculated by the dividend per share, and I will multiply that with the quantity of shares which are outstanding, not issued. Okay, quantity outstanding here. So we just need to remember this thing. There is a difference between issued and outstanding, that sometime the shares are issued and some of the shares are then purchased, backed by the company. If the company itself is buying back some of its share, then it becomes treasury stock. Okay, now in the numerical it is given that our dividend per share is $2.50. Let's see if quantity is shared with us. So the company has issued 1 million shares of common stock, of which 50,000 shares are held treasury. So actually they had sold 1 million, but then out of these 1 million, 50,000 were purchased backed by the company. So it's like 1 million minus 50,000. So the quantity of shares which are still outstanding in the market is 950,000. If we multiply this, we will get a figure of around 2,375,000. This is the quantity of dividend that would be paid actually. Now the question is it a current liability or not? Yes, it is a current liability. Earlier we discussed this, that we just had to pay that within 1 year, so obviously it is a current liability. This was the answer of transaction A. Then let's go to the second transaction. Also on December 31st, Chopin declared 100% stock dividend. 10% stock dividend to stockholders record on January 15, 2005. So look at this thing. This is an interesting development now. We are standing here on 31st December 2004, and on the very same day, the company has made an announcement that we will pay a stock dividend, but it will be recorded in the next year, January 15, 2005. So it's a record as maintained in the next year. So if the record is related to the next year, then obviously no liability will be created in this year, which is 2004. So as far as the transaction number 2 is concerned, it does not have any adjustment required, or it's not related to 2004. So we can say that the transaction is not related to 2004. It's the next year, so we only record it in the next year. We do not have any recording this year, okay? And why? Because though that announcement is made on 31st December, which is today, 2004, but the record would be updated on 15th of January next year. So the record date is important, as I discussed in the previous transaction also. Let's go to the third transaction. On December 31st, bond payable of $100 million are outstanding. So we had a bond liability of $100 million. The bond pays a 12% interest every September, okay, and matures in installment of $25 million every year. It means these 100 years will be returned in $25 million year 1, $25 million end of year 2, $25 million year 3 end, and at the end of year 4, the last 25 million installment will be paid. So the money will be paid in installments, okay? So just keep this thing in mind. It means that this $100 million loan, which is actually taken by the company, it has two parts now. It has a part of current liability and it has a part of long-term liability. Out of this 100 million, $25 million gonna be paid in the coming 12 months. And the remaining 75 million will be paid in year 2. Sorry. Okay, let me just, okay. So it would be paid in year 2nd, year 3rd, and year 4th actually. So we have this current portion of long-term liability and we have long-term liability itself. Just remember this part, okay? And other than that, there would be another part of interest, because interest is paid every 30th September, which means at the end of every year interest is paid. So we must calculate that, okay? Now, as if you can see, looking into 25, 25, 25, and 25 makes the life as 4 years actually, okay? And it expires on like 30th of September. So it means that this company, okay, on 1st of October 2004, which is 3 months from today, they issued this bond. They had this liability, okay? So from 1st of October, we have this like month of October, then November will start, so that's 2 months, and then December will start, and December will end, so it's 1 month, 2 months, and 3 months. So 3 months have passed, okay, that the liability is issued. It means, according to the matching principle, the interest expense has been incurred, though it is not paid. But that's another story, but interest expense is made here. So let's calculate how much is the interest expense, and then we will do the rest of the calculations. So in order to calculate how much is the interest expense, or how much of the interest will be payable by the end of this year, okay, so it would be the principal amount. We will multiply that with the interest percentage, and then we will multiply it with the fraction of the year, for how many months actually we want to calculate that. No? So the loan amount we have is $100 million. The interest rate, we are bound to pay 12%, okay, every year. And we wish to calculate interest payable for only 3 months, because it has been 3 months exactly that the bond has been sold, okay? So only for 3 months we are planning to do it. But this 12% interest is for 12 months actually. So that's fraction of the year. We have 12 months in 1 year, and we need to calculate it for 3 months actually. When you solve this, okay, mathematically, we would come up with an interest expense of $3 million actually. So it means that for these 3 months we're gonna pay $3 million interest payable, okay, which is an expense but not paid, so it becomes payable. So if I make the current liability section of this company, I'm gonna write here the current liability, the bond payable, and just for your reminder, I will write here current portion, means the current year portion, less than 1 year portion actually, okay. So this would become 25 million, and I discussed it that why it becomes 25 million. It's based on this discussion we had, okay. And then obviously interest must be paid every year, so we will have an interest payable also, which we have already actually calculated. It's $3 million, okay. So that would be the current liability section. As far as the long-term liabilities are concerned, for the long-term liability, we would have the bond payable only, but this bond payable would be how much? It will be $75 million, and that's it. So this would be the answer of transaction number 3. Let's go to transaction 4. In transaction 4, we have December 31st, 2003. Customer advances. If you have received money from customers in advance, it's kind of become your liability, and then when you offer the services and or offer the product or send the product, actually deliver the product, then the same thing becomes actually your earned one. So on 31st December 2003, which is the starting of the year where we are standing here, so the beginning customer advance was $12 million. So we had a liability obligation, okay, of $12 million. So I will write here the beginning CA, or first I will write completely customer advances. So how much advances we had at the start of the year? We had 12 million customer advances given in the numerical, okay. Then obviously it is business and we may come across some more advances as well. So during 2004, the company collected $30 million more customer advances. So I will add it here plus, okay, and then advances collected during 2004. So how much advances are collected in 2004? It was 30 million, if you remember. So the total liability we had was 42 million. That was the total liability we had. Obviously, just like we are collecting more advance money from customers, so some of this portion will be like what you say finished as well. So what is our, what you can say, the earned one, because if we are offering services, it become earned. So 12 million in the start, 30 million during the year, and the advances of 25 million were earned. It means out of 42 million, $25 million advances were actually earned. The remaining advances are left, which is $75 million. This is the ending balance. Okay, ending customer advances as of December 31st, 2004. And this is the customer advances earned actually. So it's completely the same technique which you have used in this cost of goods. Sorry, this one, not this one, okay. So that's kind of the same, beginning plus during, and then you can calculate ending out of it. Now the thing is it a current liability or not? Yes, indeed it is a current liability, because if you are actually collecting customer advances, so you are bound actually to provide the services or the product within the 1 year actually. So in the exercise 5.8, we were actually supposed to calculate how much dollars, and then it will be written in which section of the Chopin's company. So the first one, current liability, the second one was not even recognized as a transaction for 2004 only, okay? It is a transaction, but that would be recorded in 2005. And then in third section, we had this current and long-term portion. And in the fourth one, we had customer advances. So by default, it is always actually a current liability. Thank you very much, ladies and gentlemen. Stay safe.